Good evening, students. I hope you have revised. Today we have almost, the last class in terms of the problem solving, because in the next class, what we are going to do is, students, we are going to start with the judicial updates around those areas. So that is what we are going to do. So let's get quickly started. Uh, so have you revised the trust taxation? Yes or no? I had asked you to revise the trust taxation part. Have you revised that? Yes? Okay. So now what we are going to do is, students, we are going to solve the questions around that area. Also, I had requested you to do the sums of the read, because that is again a very important topic, and also very easier because there is nothing difficult in that. But if you remember, in the last class we had done the explanation of the problem around the read, also around the AIF. So have you done that as well? Yes. So today what we are going to do is we are going to start with the trust taxation, because I was explaining you that in the last class, trust taxation is again a very, very important area. So first we will start the question around that. And then of course we will go to the rest of the areas in terms of the transfer pricing problem solving. So, and chapter 6A reduction is also there. So all those problems we will solve. And then of course we will move on to the in the next class towards the judicial and the statutory update. So this is how it is going to be. So I would request you to please participate in the class, because otherwise it will become a very difficult situation in the examination for you. What will happen is that if you do not solve your problems on your own, then in that particular case, during the exam time, it becomes difficult to make that kind of presentation. Also, there are more chances of error in that particular case. So if you do it at this stage, you can make easily the mistakes at this point in time, and later on of course you would not be making those mistakes if you do it at this moment properly. So let's start with the question on the trust taxation. I'll just share my screen for the question part. Give me a second. Yes. So a public charitable trust registered under 12AB runs a hospital and also a medical college. It furnishes you the following information. Gross receipts from hospital rupees 425 lakhs, including the voluntary contribution, and one second. I think there's a problem. Yeah, including the voluntary contribution towards corpus, income from business, incidental to the main object, 2 lakh, voluntary contribution received from public rupees 32 lakh. It includes the corpus donation of 3 lakh from another charitable trust and anonymous donation of 5 lakh. Voluntary contributions are included in gross receipt given in one above. Hospital expenses, operational expenses incurred 105 lakh. This does not include the capital expense and depreciation. Income from medical college solely for education purpose 10 lakh. Gross receipts of college for the year were 100 lakhs. Gross receipt given in one above includes a sum of 55 lakh which has been accrued but not received. Further, a sum of rupees, further a sum of rupees 18 lakh was received only on 31st March 2020. The trust set apart 80 lakhs for acquiring a building to expand its hospital, but the amount was paid in December 23 when the sale deed was registered in its name. In June 22, the trust purchased and installed a new computer software worth 28 lakhs. The rate of depreciation is 40% as per the Income Tax Act. The trust incurred rupees 35 lakhs towards purchase of laptops, computers, and printers for the hospital. It repaid the loan of 15 lakh taken towards the taken earlier for the construction of hospital building. Donation of 2 lakhs towards the corpus to a trust registered under 1023C, and another donation of rupees 1 lakh was paid. So let's start solving the question. Yes. So first is, in this particular case, the first point here would be the trust is a charitable institution registered under 12AB. So how does the registration under 12AB works? Yes. How does the registration under 12AB works? So registration of trust. If you see, as I told you that a charitable institution has to obtain a registration under 1023C, also under 12AB also under 1023C, there are trusts which are unconditionally given the exemption. What were those? The specified trust, that there are specified trusts under 1023C. Second was the one who are wholly and substantially receiving the government grants. Then the third one were the hospital and the educational institution working solely for the purpose of education and solely for the not-for-profit in case of hospitals. And then there is a fourth category, all the other charitable trusts which are wanting to register under 1023C. For them, they have the conditional exemption. They have to first obtain the registration. Right? In terms of the registration has to be obtained under 1023C or for that matter under 12AB. So in case the trust has not commenced any activities, it has to first apply for the provisional registration. In case the trust commenced the activity without claiming the exemption under first or the second regime, so it has commenced the activity, but it has not yet claimed the first under the first or the second regime the exemption, then the trust has to apply directly for the final registration at any time after the commencement of the activity. In case it has not commenced its activity, then it has to apply for a provisional registration. In case it has commenced the activities, then in that particular case, it has to apply directly for the final registration. Are we clear? Then in that particular case, the provisional registration, if it is there, so provisional registration has to be taken 1 month prior to the commencement of the previous year. Right? And it is given for the period of 3 years. It is given for the period of 3 years. It is given from the year in which the approval is sought. However, as I said that if it has commenced the activity, it will directly apply for the final registration. And this, it has to apply within, this it will be given for a period of 5 years. The final registration, the registration validity is for 5 years from the year in which application is made. If you have received a provisional registration and if after the expiry of the provisional registration, within that 6 months before the expiry, you can apply for the final registration. Then you will have the final registration again for a period of 5 years. So again, after 5 years, you will have to renew. Now, this is the trust which is registered under 12AB. So see, with this, we have also discussed or revised quickly the registration procedure as well for the trust. Okay. So now this trust has been registered under 12AB and it also has a medical college. Now this has a gross receipt from hospital worth 425 lakhs, including the voluntary contribution towards the corpus. Now what will be the effect of this? Yes. What will be the effect of this? Yes, students. Faster. What would be the effect on this particular point? Give me the answers. It's very simple. Yes. Gross receipt from hospital rupees 425 lakhs. This is very simple one. Yes. I'm not getting the answers. Okay, let me explain. In this particular case, what would happen is there is this gross receipt from the hospital. Now, this includes the voluntary contribution also. So, how will you start with it? So, if you remember, in the last class, I had discussed the entire computation with you students. If you remember, in the last class, we had discussed the entire computation aspect on this particular point. Now, this 425 lakhs, which is given, this is including the voluntary contribution towards the corpus. Isn't it? So, let me again go back to the solving of sum. and first take you to the computation procedure. So see, what we had written over here, we will start with income derived from property held for charitable or religious purposes in India. We would start with that aspect. Now here income, if you remember, I had told you that income here would mean the income which is the gross receipts and not the net receipts. Now in the question, if we go back, it says income gross receipt from the hospital is 425. This has also given you the total amount which is the expenditure also, hospital operational expenses. So here you would not take 425 minus the operational expenses of the hospital. Here what you will do is, you will take 425 lakh in entirety. However, out of that, the corpus donation would get excluded. The corpus donation will get excluded in this particular question. Because what did I tell you? That the corpus donations are not to be considered in the income. These are the capital receipts, student. These are the capital receipts and these are not to be considered as the income under the computation. So we'll start solving the question. So trust taxation. So computation of total. Okay. So first is the gross receipts from hospital. Excluding the corpus donation. Okay. So rupees 425 lakh minus, you will do the corpus donation. What is the corpus donation given in the question? So it is given as 32 lakhs. So voluntary contribution from the public was rupees 32 lakh. It includes the corpus donation of rupees 3 lakh from another charitable trust and anonymous donation of rupees 5 lakh. So here, first what we will do is, we will reduce the entire voluntary contribution. We will take the gross receipts over here separately. And then of course, we will do the voluntary contribution. We will show it as a separate line item also. And then of course, what we will do is, we will reduce from that corpus donation. So for now, I am excluding the entire voluntary contribution and not just corpus donation. Okay. So let me just, you can do other way also. So we can do the other way as well, but let me do it like that. Excluding the voluntary contribution. So minus 32 lakhs. So this will give me 425 minus 32. 393. Fine. This will give me 393 lakhs. Now, what is the next aspect that we have to take into consideration? Let's go back to the question. So, income from business incidental to the main objects, rupees 2 lakhs. Income from business incidental to the main object, rupees 2 lakh. What would be the adjustment of this? Yes. Income from business incidental to the main object, rupees 2 lakh. Business income incidental to main object. Remember what did I tell you? Here, this particular trust is engaged in the business of hospital and medical college, running a hospital and a medical college. Now, if you have any ancillary income, what is the effect? Here, this trust is not under 1023C. This is under 12AB, it is registered. Right? Here it is registered under 12AB. So what is a charitable purpose? If you remember, so let me take you back now. What is my charitable purpose defined? Under 250. Relief of poor, education, yoga. Here in this case, whether we will test the 20% condition which is there under the advancement of any other object of general public utility. Because what it was said is that the advancement of any other object of general public utility shall not include carrying out of any activity in the nature of trade, commerce, or business. So, advancement of any other object of general public utility will not include the carrying out of any activity in the nature of trade, commerce, or business. However, there is an exception to that. What is the exception? It says that the activities are undertaken in the course of advancement of object of general public utility, and receipts from the activity, which are though in the nature of trade, commerce, or business, are less than 20% of the total receipts. Then in that particular case, we will still be considered as falling within the objective of advancement of any other object of general public utility. Are you getting my point? So here, my question is that should we test this exception? First of all, whether we fall into this particular advancement of any other object of general public utility. Because if you fall under that, then only there will be a condition that it should not include carrying out of any activity in the nature of trade, commerce, or business. And therefore, only when you do any other business, if you want to claim the exemption, if you want to say that, okay, I am doing a charitable activity, you should fall then under the exception. For falling under the exception, what is the exception saying? That my activities should be in the course of advancement of objective of general public utility, and the receipts from my activity should be less than 20% of the total receipts. Are you following that? So then in that particular situation, whether here I will test this condition or not, this is my question to you. The answer to that would be no. Why it would be no? Because what is this particular charitable institution doing? It is running the hospital and running the educational institution, a medical college, both of which are not falling under the ancillary clause of advancement of any other object of general public utility, because both are specified clauses. Charitable purpose includes education and the medical needs. So this exception which is there, that any other business activity that I undertake should be in the advancement of the object of general public utility, and its receipts should be less than 20% of total receipts, is only for the last clause, which is the G clause, which is advancement of any other object of general public utility. Because that is where the restriction is, that I should not be doing any activity in the nature of trade, commerce, or business. This restriction is not for yoga, medical relief, or for education or relief of poor. This particular restriction is only for the last clause, which is advancement of any other object of general public utility. So now, if that be the case, here, even if I am undertaking the business income, I would not test whether my receipts from this activity are less than 20% of the total receipts. I would not test on that point for sure. Are we getting this particular point? So here, what we just need to do is, we have to ensure that this is an incidental income and separate books of accounts are to be maintained for this. That's it. So if the charitable trust, other than the advancement of any other object of general public utility, has engaged in any other business activity, either under 1023C or one who is registered under 12AB, business shall be incidental to the main objects of the trust and separate books of accounts should have been maintained. This is what we have to do. So just write it down over here. Give me a second. So what we will take into consideration over here? Income from business, incidental to main objects, so it is given it's incidental to main object, rupees 2 lakh. You can just write it over here. It is not to be tested as to whether the receipts from business are less than 20% of the total receipts as education and medical relief are not, as education and medical relief are not, yes, are not falling within the purview of the advancement of any other object of general public utility. So these are the specified clauses, and therefore there is not necessary to test this particular activity. Okay. So therefore you can just write down and not the falling under advancement of object of general public utility. It needs to be, or you can just write, the trust should maintain separate of accounts for the incidental activity. Are we clear? Yes or no? Okay. Now the third point. Voluntary contributions received from public were rupees 32 lakh. This is what we have discussed. It includes the corpus donation of 3 lakh from another charitable trust and anonymous donation of 5 lakh. So voluntary contributions are included in gross receipt given in one above. So we'll now talk about the voluntary contributions. So 32 lakh from this, we are excluding the corpus donation. Right? We are excluding the corpus donation from this. What is the corpus donation amount? It is 3 lakh. Now, what about the anonymous donations? Remember in the last class, we were speaking about the anonymous donation. Right? We were speaking about the anonymous donation. So, what we have to do in that case? How much anonymous donation you will consider over here? Yes, what did we discuss in the last class about the anonymous donation? So anonymous donation, 5% of the total donation or rupees 1 lakh, whichever is higher, that shall be excluded. Balance shall be taxed under 115 BBC at the rate of 30%. At the rate of 30%. Isn't it? So therefore, in this situation, if we talk about what are the anonymous donations given in this question, the anonymous donations here are rupees 5 lakh. So can you calculate for me what is the amount of anonymous donation? The excess amount which should be taxed here. Yes. So 5% of the total donations. What will be my total donation over here? Yes, 5% of total donation. What is my total donation? If you recollect, in the last class itself, I had given you that what would be 5% of my total donation. So total donation in this particular case shall be corpus donation, voluntary contribution, and the anonymous donation, all three taken together. So what is my total donations? 32 lakh. 5% of that comes to 1.6 lakh. Isn't it? Now 1.6 lakh or rupees 1 lakh, whichever is higher, that amount will be considered. Isn't it? So 1.6 lakh. So 1.6 lakh minus 5 lakh. So 3.4 lakh is going to be taxable under 115 BBC. Are we getting that? So therefore, how will you present over here is? So first we will exclude 5 lakh from this. So what is my voluntary contribution here? The 24 lakhs. Then I'm coming to the anonymous donation. So anonymous donation here will be 5 lakh minus, sorry, here what we have to do is 5% of total donation, or 1 lakh, whichever is higher. So 5% of 32 lakh or 1 lakh, whichever is higher, 1.6 lakh I will consider over here. The excess donation is, so the excess donation, which is 5 lakh minus 1.6 lakh, this is going to be 3.4 lakh, taxable at the rate of 30% under section 115 BBC. So this will be considered as a normal donation, eligible for the application of income. Eligible for application of income. Yes, are we clear about this? Any questions, any doubt so far? Okay, let's move further. Then let's come to the next adjustment. So hospital operational expenses incurred rupees 105 lakh. This does not include any capital expenditure and depreciation. And here I have just written just now one more adjustment. Salary to medical staff on which TDS is not deducted, rupees 20 lakhs. So hospital operational expenses, rupees 105 lakh. What would be the effect of this? Yes. Hospital operational expenses, we will take entire 105 lakh, but the expenditure on which TDS is not deducted. So salary to medical staff on which TDS is not deducted. So on that amount, what we would do is, we would do 20 lakh into 30% is what we will disallow. 20 lakh into 30% is what we will disallow. Are we clear? Yes or no? Right? Any doubts so far? Yes. So what we will do here is, if you remember in the last class, what did I tell you? I said that in case the expenditure is paid on which TDS is not deducted, then in that particular case, you will have the same impact as what you do under PGBP. You have 40A1A becoming applicable, isn't it? You have 40A1A becoming applicable. So here, it would be the similar situation. Are we clear? So here 40A1A will become applicable, and therefore 30% of that we will disallow. Fine. So just write down over here. Okay. So less operational expenses 105 lakh. From this, I will not allow less the salary to medical staff on which TDS is not deducted. So 20 lakh into 30%, 6 lakh I will not allow. Fine. Then you have next question, next particular item, income from medical college solely for educational purposes, rupees 10 lakh. The gross receipts of college for the year were rupees 100 lakhs. So what would be the impact under this? Yes. What would be the impact under this? Income from educational institution. 100 lakhs is how much? 100 lakhs is how much? This is existing solely for education purpose. So let's go back to our, again, trust taxation that we have discussed in the last lecture. And let's see what it says. So if you look at this particular point, it says educational institutions existing solely for educational purposes. And if the annual receipts are less than rupees 5 crore, and if the annual receipts are less than rupees 5 crore, then in that particular case, your income would be unconditionally exempt under 1023C. Isn't it? My income would be unconditionally exempt under 1023C. Now, this question, what do you think? Whether my income should be exempt under 1023C? Yes or no? Give me the answer fast. Yes. So here they have said income from the medical college is 10 lakhs and the gross receipts of the college are 100 lakhs. So what would be the effect over here? Yes, faster. Yes, faster. Whether we will take this or whether we will exclude it, what we would do. Yes, I'm not getting any answer. What we will do in this case? So income from the medical college, as it does not exceed the gross receipts of 5 crore, then in that particular case, this income shall be exempt under 1023C, isn't it? This shall be exempt under 1023C. Now you would say, ma'am, but in this particular case, we also have the hospital which is running, isn't it? We also have a hospital, and what you have said so far is that in case they combine the seats from both the hospital as well as college exceed rupees 5 crore, then in that particular case, the unconditional exemption is not available. Yes, students, you are correct. But in this question, if the question would have said that this particular institution which is there is claiming the exemption under 1023C even for the hospital, I would have agreed with you that the combined receipts from the hospital and the educational institution are more than 5 crore. So therefore, this will become taxable. But in this case, if you see, the registration is obtained under 12AB. The registration is obtained under 12AB. Now 12AB, for which trust you can obtain the registration. Under 12AB, for which institutions we can obtain the registration? Yes. 12AB is what? Procedure for registration. So that is particularly for the applications which are made under 12A, which are made under 12A. Now 12A is basically the trust which are claiming the exemption under 11 and 12, not under 1023C. So this particular 5 crore condition which is there is for the trust which are registered under 1023C and not under 11 and not under 12AB. Both are different regimes, isn't it? But here, my educational institution which is there, or the medical hospital which is there, in that particular situation, for that particular medical hospital, I can still claim 1023C because it is operating solely for educational purposes. So I have two set of segments. One is the hospital and second one is the educational institution, isn't it? So here I have done a 12AB registration. So for my hospital purposes, I cannot consider that 5 crore. However, for the medical college, which is solely for educational purpose, which is operating, I can claim the exemption under 1023C because the medical college is operating solely for the educational purpose. What did we understand by the meaning of the solely for educational purposes? So we had the decision of Supreme Court in Noble Society, New Noble Society. We discussed that day. That educational institution will be considered as engaged solely in education if the educational institution is not engaged in any other business activities unrelated to the objective of imparting the education. So solely here means that it should be exclusively in the business of the or in the it should be exclusively engaged in the education purposes. So only when you maintain separate books of accounts and that activity is incidental, then it is fine. But otherwise, you should be only engaged in education activity. So here, since my income is less than 5 crores, my gross receipts are less than 5 crores, 100 lakhs, which is 1 crore, isn't it? So then in that particular case, I will be entitled for exemption under 1023C. Are we clear? So just let's write down. Let's write down over here. Income from educational institution operating solely for educational purpose. Exempt under section 2023C as gross receipts less than rupees 5 crore. As my gross receipts are less than rupees 5 crores. Here, the hospital is registered under section 12AB. Therefore, the aggregate gross receipts of hospital plus educational institution are not to be considered. If let's say for example the hospital was also registered under 1023C, if the question would have said that we are registered under 1023C, then of course in that particular case we would have considered the aggregate receipt. So you can just write down, if hospital is registered under section 1023C, then aggregate receipts greater than rupees 5 crore. Therefore, no exemption under section 1023C. Are we clear? So in that particular case, let's assume for this moment that, okay, this is registered under 1023C. Then in that particular case, what you would do is you would add even the income from the medical college, which is rupees 10 lakh. So then in that case, you will just add here 10 lakhs. Are we clear? So my income is coming to, I will take this little down. Okay. So my income is coming to income from charitable activity. What does it come to? 430.6, right? 430.6, is it coming to 430.6? Yes or no? Confirm the total to me. All of you are getting 430.6 or not? Yes or no? Faster. Yes. 430.6 is the total answer. My total income. Isn't it? Yes or no? Faster. I'm not getting any answer. 393 lakh is my gross receipts, isn't it? Minus 32 lakh. Okay. So 430.6 is my income from charitable activity. Now what will be the next step over here? We will give the ad hoc exemption of 15%. So here we are giving the ad hoc exemption of the 15%. So less ad hoc exemption of 15%. So how much does it come to? 64.59. So here you have to write the note. What is my note here? The ad hoc exemption of 15% is applied on the gross income before considering the operational expenses. So I have not reduced the operational expenses as I told you. Income here means we are considering the gross receipts. And this is in line with the Supreme Court ruling of Program for Community Organization. You have to write this note. Okay. Program for community organization Supreme Court ruling. This is very easy to remember. Also, the name is very simple. Fine. Now let's move to the next part. What does it say? Then gross receipt given in one above includes a sum of rupees 55 lakh which has accrued but not received. The sum of rupees 18 lakh was received only on 31st March 2024. So first we'll talk about 55 lakh. What will be the implication of 55 lakh? It is accrued but not yet received. So what will be the effect? Yes. Yes, students, please faster tell me what will be the effect of this. Income accrued but not received. Yes. So if you recollect, I told you about the deemed application in the last class, isn't it? So what did we discuss in the last class? So we discussed about the concept of deemed application. So 85% of income which is there, which is now we will consider as the deemed application if I follow the accrual system of accounting and where the income is accrued but not received to me. This will be considered as deemed application for that particular year. The condition is that the income should be applied in the year in which it will be received or in the following previous year to that year. If it is not applied in either of these years, it will be considered as the deemed income of the next following previous year. Are we clear? Now here, what do you need to consider here? Here you have to exercise the option by filing Form 10 whose due date is 2 months prior to the due date of return of income. So here you have to exercise the option of filing the Form 10 and the time limit is 2 months prior to the due date of filing the return of income. Here the CBDT circular does not extend the filing of due date till 139 Monday. In this case, you have to file 2 months prior to the due date of return of income and then only it will be considered as my deemed application. So just write down over here, less second. Am I audible? I think my computer has got hanged only. एक ही मिनट. हाँ, मेरा पीसी आई थिंक हैंग ही हो गया है. एक ही सेकंड देखते हैं. यस. एक ही सेकंड दे दीजिए. Yes. So here it would be less. This would be less my deemed application for the income accrued but not received. Right? So this will be 55 lakh. Are we clear? Then 18 lakh was received only on 31st day of March 2023. So 18 lakh was received on 31st March 2023. So again, I said the same thing in that case as well. That would also be considered as the application of income, deemed application. The condition is it has to be applied in the next year. If it is not applied, this will be considered as my deed. Are we clear? So therefore, this will also be considered as deemed application. Income received on last year. How much is the income? This is 18 lakh. Next is the trust set apart. The trust has set apart 80 lakhs for acquiring a building to expand its hospital. But the amount was paid in December 2024 when sale deed was registered in its name. So what will be the effect over here? The amount set aside for the building, will it be allowed as the application? Yes. Will it be allowed? Yes or no? Pastor, do you think this will be allowed? So here, there are two views. See, one view is that this amount is set aside for the particular purpose, for a specified purpose. So then it should be considered as the deemed application. You have to file the form 10 in that case by the due date under 139(1). The second view you can also take here is that the amount will be allowed as application only on the payment basis. Only on the payment basis you will allow. So you can take the two viewpoints over here and accordingly modify your answer. So just write down over here. Less deemed application for amount set aside for building. What is the amount which is given? The amount is 80 lakhs. So here you can just write alternate view. Amount would be allowed only on payment. Okay. So fine. Now the next adjustment here is in June 2023, the trust purchased and installed a new computer for rupees 28 lakh. The rate of depreciation is 40% as per the Income Tax Act. So yes, I have purchased as a trust a computer. So then in that particular case, will I be allowed this as an application? Will I also get the depreciation on that? So when you consider the computer software as application, so the depreciation on the same will again not be allowed as the application. Are we getting that particular point? So therefore, in this situation, we will allow the computer but not the depreciation on that. So less computer depreciation on computer not allowed. So how much is the amount given? This amount is 28 lakhs. Then the trust has incurred the 35 lakh towards the purchase of laptops, computers and printers for the hospital. So again, that will be allowed to me. So 35 lakh, I will consider this as an application of income. Less purchase of laptops and printers, 35 lakh. Yes. Then next one is the trust has repaid the loan of rupees 15 lakhs taken for the construction of the hospital building. So what would be the impact of this repayment of loan? We discussed that day also. Yes, repayment of loan. What we would do in that case? Repayment of loan. What we discussed that day? So repayment of loan or borrowing is allowed. Repayment of loan or borrowing is allowed, but there are certain conditions attached to that. Isn't it? There are certain conditions attached to that. And what are those conditions? So there are the conditions in terms of that the loan should be Utilized not for the purpose of corpus donation to another trust, isn't it? So the loan should be utilized not for the purpose of corpus donation to another trust. Then second condition is that the loan should be applied in India. I'll take you there. Loan should be applied in India. TDS should be deducted on the expenditure. TDS should be deducted on the expenditure which is paid. The expenditure through loan should not be in cash more than 10,000. Application should not be for the benefit of specified purpose, a specified person, and repayment of loan should be made within 5 years from the end of the previous year an application was made from loan. Are we getting this particular point? So therefore, in this situation here, since none of these conditions are mentioned to us, but in case, let's say, for example, if the question would have told you that the application has been made from the loan for the cash payment of salaries, you would not allow that. You would not allow that, isn't it? So the application, so the repayment will be allowed. So that will be allowed subject to satisfaction of the certain condition. Application, let's say for example, if I say that from the loan amount, I have applied the loan amount towards payment of salaries, towards purchase of any fixed asset. So application from the loan shall not be treated as application of the income for the charitable trust. Are we clear? But when we are repaying the loan, when we repay the loan, so to the extent of such repayment, we will be allowed this as application. However, it is subject to satisfaction of these conditions. Are we clear? So just you will write down over here. Less repayment of loan. How much is the repayment of loan? 15 lakh. Are we clear? We'll just write it over here. If question provides loan of rupees 10 lakh was applied for purchase of building. No application allowed. Or you can just consider, right? Not considered as application of income. Not considered as application of income. Then, if question provides loan repaid of rupees, so if my loan repaid, which is there of rupees 15 lakh, however, application of loan was made for payment of salaries of rupees 2 lakh in cash. So to this extent of 2 lakhs, this is not considered as application. Only 13 lakhs will be considered as application. Are we clear? Yes or no? Any questions, any doubts so far? Okay? Yes or no? Any doubt? Fine. Now, the next part is donation of rupees 2 lakh towards the corpus to a trust registered under 1023C, and another donation of rupees 1 lakh paid by the bearer check. So, whether donation to the corpus of another trust first, will it be considered as the application of income? Yes. Will it be considered as the application of income? Yes or no? Faster? Yes or no? Yes, faster. So, if I am paying to the corpus of the trust, that is not considered as the application of income. That is not considered as the application of income. Do you remember that? So, we had specifically discussed this particular point, that corpus, donation to the corpus of the other trust is not considered as the application of the income. So in this particular case, this will not be considered as my application of income. So even though I have contributed to the corpus of the other trust, this will not be considered as the application of my income. Very clear. So donation towards the corpus and even donation by bearer check will not be considered as application of income. So we can just write it over here. Donation towards corpus of trust and donation by bearer check not considered as application of income. What if my question would have said, if question provides donation to other trust engaged in religious activity through account paid check, let's say rupees 1 lakh. Then in that case, how much will you allow for the deduction? How much will you allow for the deduction? In that particular case, when you give the donation to the other trust, remember I told you that day that donation to any other trust, irrespective of its objective, even if it is engaged in religious and I am engaged in the hospital and education field, that would not be problem. But the application will be allowed to the extent of 85% of the amount donated. Are we getting that? So application here will be not entire 1 lakh, but 1 lakh into 85%. Are we getting that? So therefore, Just write it down over here. Application allowed shall be 1 lakh minus 15% is equal to 85,000. Yes. Are we clear about this particular fact? Yes or no? Any question, any doubt? Yes. Clear? What if the question says amount which is deposited in any of the modes which are specified in section 11.5? So, if you deposit the funds in the mode which is specified under 11.5, then you will have the deduction which is available. Application which will be considered. So if you deposit the funds in any of the modes specified in section 11.5, then you will be considered that you have applied the amount. You have applied the amount. So any amount utilized from those funds which are deposited under 11.5 will not be considered as application. Are we clear? Or any corpus donations which are received, which are utilized towards its objective, will not be considered as application. Are we clear? So the corpus donations are also not considered as application. Amount that you deposit into the 11.5, that will be considered as application. Are we clear? Yes or no? Any questions so far? Any doubt? Yes or no? So you can just write down over here. If question says application of rupees 1 lakh was made from corpus donation, this is not considered as the application. Yes, this is not considered as the application. However, if amount is deposited in modes under section 11.5, then this will be considered as application. But this is subject to the satisfaction of the condition. What were the conditions that we saw? So this is application subject to conditions. What are the conditions that we had seen? Yes, what are the conditions that we had seen? That it should not be application, first of all, should be this application should be in India. Application should not be by way of donation to the corpus of the other trust. The TDS should have been deducted on the application. Any application where the payment exceeds rupees 10,000. So any application where the payment exceeds in 10,000 in cash will not be allowed. Are we clear? And the application will be allowed in the year in which it is actually paid. Clear? Any questions? Any doubt? So here one more condition you can just write down. It should not be for the benefit of specified person, and if the trust or the institution deposits the amount into the corpus, deposits the amount into the corpus within 5 years from the application. So same like repayment of the loan. Yes or no? Okay, fine. Now the last point is regarding the capital gain. Also, one more adjustment before we go to capital gain. Let's say, for example, if the question would have suggested that expenditure is paid, the operational expenditure which are there, that is paid in cash. Let's say rupees. Let's assume an amount over here that there is certain level of expenditure which is paid in cash. Let's say 30,000. Or expenditure is incurred during the year but not paid. So in that case, that will also be disallowed. So let's say, for example, I'm assuming over here, let's say expenditure paid in cash. So then in this case, 30,000 will be reduced. Let's say expenditure incurred but not paid. If I've incurred the expenditure but I have not paid, so I told you that the expenditure would be allowed in the year in which you finally make the payment, irrespective of the method of accounting. So in this case, let's say, for example, I'm assuming these 2 lakh. These are assumed and not given in the question. So then in that case, you will have the this. Are we clear? Fine. Now the last point I have added for the capital gain purpose also. So what it says is the building was sold for 10 lakh. It was purchased in 12-13. Another building was purchased for 13 lakh. Index cost of acquisition is 4.5 lakh. Now, in case where there is a capital gain transaction, I told you that day also. So here, let's say my sale consideration is what? 10 lakh. Okay. So I will consider this here. Let's say capital gains over here. Sale consideration is 10 lakh. From this, I will reduce my indexed cost of acquisition, right? This is going to be how much it is given? 4.5 lakh. So minus indexed cost of acquisition 4.5 lakh. So 10 minus 4.5, 5.5 is my capital gain, long-term capital. Now here, this will be considered as application of income. Here, the application of income will be considered. What did I tell you in the last class? So, the application of income, if I reinvest the entire sale consideration for acquiring the new asset, if I reinvest the entire sale consideration, which I have done so, then the deemed application will be my capital gain. So entire capital gain will be considered as my deemed application. Entire sale consideration is reinvested in new asset. So application of income will be 5. Are we clear? In case I have invested, let's say part sale consideration. Let's say I have invested only maybe 8 lakhs. So then in that particular case, the application will be, let's say, if part sale consideration is invested in new asset, then in that case, my application shall be cost of new asset, which is, let's say, 8 lakh minus the cost of old asset minus the cost of the old asset. Are we getting this particular point? So in this case, my application will be what? What will be considered as the cost of the new asset? Yes. What will be considered as the cost of new asset? So in case where the part amount is invested, in case where the part amount is invested, then in that particular case, the part amount only will be allowed here. So my cost of the old asset is 1 lakh. So in that case, what is my cost of old asset? Sorry, the building was purchased for what amount? The cost is not given. Let's assume the cost is 3 lakh. Assuming the cost is 3 lakh. So here, let's say, not the index cost, but the cost. Let's say 3 lakh. So there it will be 5 lakh as my application. 5 lakh will be considered as my application. Are we clear? Yes or no? Any questions? Any doubt? Yes? So if this is clear, let's call for a short break of 10 minutes and then we get back. Let's take a break of 10 minutes. Yes. Around this particular point, under the charitable trust, we are already done with charitable trust. We'll do some other recap of the other points also before we move on to the next topic. So we'll just quickly recap. Okay. Now, denial of exemption under section 13. So if income held under the trust for private religious purposes or for the benefit of any particular religious commodity except for the scheduled caste, scheduled tribe, that would be resulting in denial of exemption under 13. Or if the income of the trust is applied for the benefit of a specific person, then in the hands of the trust, first of all, there will be denial of exemption under section 11. So if income is applied for the benefit of specified person, the exemption will not be available under section 11. So to that extent, to which the income is applied, to that extent only, there will be the denial of exemption under 11 and not the entire exemption will get denied. So income which is applied, let's say for example, if I have 10 lakh rupees, I have applied let's say 1 lakh rupees as the income for the benefit of a specified person, then only to the extent of 1 lakh, I will not be eligible to claim the exemption under section 11. Now this could also be forming part of a question and you will have to make accordingly, disallow the application to that extent. That will be considered as taxable income. The other part of the income will be continued to be available for the exemption under section 11. There will be the tax on this income at the rate of 30% on the gross basis without any deduction of the expenditure. Plus, there will be penalty under section 271 AAE. 100% of the amount applied will be penalty if it is done for the first time. If it is done as subsequent again subsequently also, then 200% of the amount applied will be considered as penalty under 271 AAE. Plus, in the hands of the specified person, this would be considered as the income under 56 to 10. Are you getting that? So under 56 to 10, any amount which is given from the trust is not considered under 56 to 10. But in case it is applied for a specified person, this would be taxable even under the 56 to 10. Right? Under 56 to 10 only when it is exceeding rupees 50,000. Are we clear? If we give any movable property, immovable property, or for that matter, we give the cash. Right? So if it is more than 50,000, then only we will have 56 to 10 applicable. Are we clear? Then in case we are depositing the funds other than section 11(5), then also there will be denial of exemption under section 11, under section 30. This is not applicable in case the funds are in the nature of PGBP. So if the trust has charitable income plus incidental business income, then the incidental business income is not to be deposited under the modes which are given in 11(5). That will be deposited in other modes also. So the restriction of depositing in the modes under 11(5) is applicable only for the charitable income. If it is incidental business income, then also that particular condition will apply. But if you have not the incidental income, then this condition is not applicable. Are we clear? Then the anonymous donations forming part of the corpus trust are not exempt. So excess donations will be taxable under 115 rules. Are we clear? So donation, anonymous donation excess of 5% of total donation or rupees 1 lakh will also not be eligible for exemption. So if you see in the last question what we had dealt, we had not considered that excess donation as the part of the above for the purpose of application. The excess donation are separately written over here, which is to be taxable at 115 BBC. From this, you will not consider any application of the income. Are we clear? So this is number one. Then secondly, the Form 10 is not filed within the due date of the return of income. Are we clear? Or the return of income is not filed for accumulation of income. So then in that particular case also you will be denied the exemption under section 30. Are we clear? Now in case the income is applied for the specified purpose, so specified person. In that case, there are certain deemed conditions also. That if the loan is given without security, use of the property without rent, excess payment for services, inadequate remuneration is given, or investment is made in substantial in a concern in which you have substantial interest, diversion of income is there, inadequate consideration is paid. So all of those would result in the denial of the exemption. And the specified person here means author of the trust, or the trustee, or the relative of the trustee, contributor more than 50,000, any concern in which the above person have the substantial interest. However, if the educational institution or hospital is providing educational or medical facilities at a concessional rate, then the exemption will not be denied. So, for example, in the earlier question, the question could have one information that the amount is applied for the settler of the trust, or amount or the it could have been that the trustee son has been given admission in the medical college at the concessional fee of rupees, let's say 1 lakh. Whereas the fees charged to the other students is, let's say, 5 lakh. So in that particular case, the exemption under 11 will not be denied. It would still be eligible for the exemption. In case the question would have said that the settler is paid remuneration of rupees 50,000. Right? If the settler is paid remuneration of 50,000, or if the settler is paid or if the settler purchases the property, or the trustee purchases the property for, let's say, 5 lakh rupees. The value of the property is just 3 lakh. So then in that particular case, this will not be eligible for exemption. Then you have specified income under 115 BBI. So if income accumulated is greater than 15%, where accumulation is not allowed as per Act. So accumulation is allowed for less than equal to 5 years by filing the Form 10 before the due date of filing the return of income, and by filing the return of income on time. However, if income accumulated which is more than 15%, where it is accumulation is not allowed as per Act, or in case there is a deemed income on account of violation of conditions for accumulation of income, that is, the income is applied for other than charitable or religious purpose, or it ceases to be remain invested in the mode specified in the 11.5, or it is paid to a trust which is not registered under 12A, or it is not utilized for the purpose for which it is accumulated. So in these particular situation, it would be considered as the deemed income under 115 BPI. Are we getting this particular point? So, in case the income is not applied in a manner in which it has to be applied, right? Or it is, for example, the amount is deemed violation of, there is a deemed income on account of violation for the accumulation of income. So, it ceases to be remain invested in the mode specified in the 11.5. Then in that particular case, this would be considered as my deemed income. And section 115 BPI will become applicable, which is at the rate of 35%. Fine. So which ones are there? Income accumulated in excess of 15%, where such accumulation is not allowed under the specific provisions of the Act. Or there is deemed income on account of violation of the conditions which are given for the accumulation of the income. Are we getting that? So what are the conditions which are given for the accumulation of income under 11.3? So under 11.3, what it says is that there are certain conditions that the accumulated or income of the trust should be applied for the purposes which are charitable or religious. Where the income is applied for purposes other than the charitable or religious, or the objects of the trust, or it ceases to be accumulated or set apart for application, or it ceases to be remain invested or deposited in the mode specified under 11.5, or it is not utilized for the purpose for which it is accumulated or set apart, or it is paid to any trust or institution which is registered under 12AB or 1023C. Then in all these situations, here you should also write 1023C. It will be considered as deemed income in the year of violation. So from the accumulated amount, if you pay to any other trust of it, it ceases to remain invested, or it is applied for other than charitable religious purpose, or it not utilized for which it was accumulated, it will be considered as deemed. Then income not received during the previous year and is also not applied in the next year or the previous year following that year. Then it is deemed income of the year in the year following the year of receipt. Or if the income is received late and again it is not applied by the next year. Or if the income is deposited in modes other than 11.5, or if the income is applied for the benefit of specified purpose, or income for charitable purposes outside India, then the tax will be at the rate of 30% on gross basis. Further, no deduction will be allowed. Are we clear? Yes or no? Any questions? Any doubt? Yes? Is this clear? Fine. Now, the last part in the charitable trust is the tax on accreted income, the exit tax. So, section 115 TD is applicable when, in the case of the conversion of the trust into form which is not eligible for registration under 12A, 12AB, 1023C. So, there is a deemed conversion on the cancellation of the registration or the modification of the objects of the trust, and the income is not applied, for the trust has not applied for the fresh registration, or the registration is rejected. Or failure to make reapproval or re-registration, or renew the registration, or final registration whereas provisional is due to expire. Or there is a merger with any entity which is not having the similar objects. Or there is a dissolution, and in that case there is non-distribution of any assets on the dissolution of the trust. Then within 12 months from the end of the month of dissolution. Then in that particular case, there will be the tax under 115 TD. There will be tax under 115 TD, which is on the accreted income and at the rate of MMR. MMR will be 34.944%. What is my accreted income? Accreted income is FMV of total assets as on the specified date minus the total liability. Here, the assets from agricultural income, assets which were prior to the approval of the trust, which were bought, those will be excluded, and assets transferred to charitable institution on dissolution, all of that will be excluded. Yes or no? Any question? Any doubt? Yes? Yes, any question? Yes, fine. Okay. So with this, we have completed the charitable institutions also. So if you have no doubt, I think we can do one more question on the chapter 6A deductions at this stage. So I will not revise the entire chapter 6A deduction. What we are going to do is basically NAA and ATIA, all of those sections. So we'll just quickly look into that and we'll solve one question around that particular point. Other than that, the normal chapter 6A deductions are very, very simple. So you can do it yourself, revise, and you can look into the classes which have been done for May 2024 attempt as well. So we'll take into consideration the ATIA, ATIAB, ATIB, and ATIB. So first is ATIA. The eligible businesses developing or operating and maintaining any infra facility, industrial parks, power generating or distribution in units, inland container depot, all of these are eligible businesses. The quantum of deduction is 100% of the profit derived from the eligible business. Eligible period is 10 out of 15 assessment year. Here you should have filed the return of income under 139 month for claiming the deduction and the audit before the due date of 44A. Are we clear? Then the second one is ATIAB, which is development of SEZ. It will also include income from leasing of the developed spaces along with amenities in SEZ, and this would be PGBP and not IFHP. Then 100% of the again profit derived from the eligible business. Then you have ATIB, which is again processing, preservation, packaging of fruits, agricultural commodities. Again here 100% of the profits from the eligible business for first 5 years, 30% for companies, 25% for others for next 5 years. And then the next one is ATIBA, which is the developing and building the housing projects which have been approved between the June of 2016 to March 2022 and completed within 5 years from the date of approval. So in that case, again, 100% of the profits are eligible for deduction. Then you have ATIE, which is undertaking in the northeastern states engaged in manufacturing or production. The eligible business will get 100% of the profits as the exemption. And the last two are ATIAC. ATIAC is for the startups, including the company or LLP, incorporated between 1st April 2016 to 31st March 2024, where the turnover is less than equal to 100 crore, which are registered with DPIIT, engaged in the innovation, development, improvement of products or services or scalable business model, not formed by reconstruction or splitting up, not formed with old plant and machinery. The exception is similar what you have under 115B, which is imported second-hand plant and machinery, or if the value of the plant and machinery, which is second-hand, is less than 20% of the total plant and machinery, that should be fine. So in 3 out of the 10 years, you will get the deduction under ATIAC. And then you have ATLA, which is offshore banking unit in SEZ, unit in SEZ. So again, there you have the deduction under ATL. Are we clear? Now, if you claim the optional tax regime, you will not get the deduction under ATL. You will not get the deduction under, under ATIB and ATIBA. You can only get the deduction under ATL. ATLA will be available even under the concessional tax regime. Are we clear? Then there is one more important point, that in case there are certain disallowances made under 43B, 40A, 40A1A, 40A2, all of those disallowances which are there. So whether on the income after disallowances you will claim the ATIA, ATIB deductions, or on the prior to disallowances. So CBDT has clarified in this respect that the disallowances which are made under any of the sections which results in the enhancement of the profits of the eligible business, then deduction under Chapter 6A shall be admissible on the enhanced profits after the disallowances. The deduction will be available on the enhanced profits after the disallowances and not prior to the disallowances. Also where, let's say for example, a company has an eligible business and a non-eligible business. And let's say it has a loss under the eligible business. Eligible business means one who is claiming the deduction under these profit-linked deductions. Then can you set off the loss from the eligible business against the non-eligible business profit? That is the question. So the losses of the eligible business can be set off against the non-eligible business income under Section 70 because this is an intra-head set-off of loss. Since there is no profit from the eligible business, ATIA is not applicable in that case, and therefore losses can be set off under Section 70. Are we getting this particular point? So in case you have losses from the eligible business and you have the profits from the non-eligible business, you can set off under Section 70. ATIA is not applicable. But where, let's say, for example, you have the loss under the non-eligible business, then the question is that whether you can claim the loss set off first or you can do the ATIA first. So let's say, for example, my profits from the eligible business are 90 lakh. The loss from the non-eligible business is 20 lakh. Then the question which arises that first, should I claim the deduction under ATIA or I should claim the loss first? So basically, I should claim the deduction under ATIA on 70 lakh, 90 minus 20 lakh, or on the 90 lakh. That is the question. Are you getting this particular point? Or it should be 70 plus 25 lakh. So that is the question which we have. So in that particular case, it is important to note that the Supreme Court in Reliance Energy Limited case had observed that the ATIA says notwithstanding anything contained in any other provisions of the Act. So meaning it overrides all the other provisions of the Act. So for the purposes of determining the quantum of deduction under ATIA 5, the profits of the eligible business shall be computed as if the eligible business was the only source of income of the assessee. Even section 80AB, it says that income from the eligible business shall alone be deemed to be the amount of income of that nature which is derived by the assessee and included in the gross total. And ATA says chapter 16 should not exceed the gross total. Are we getting that? So in case you have an eligible business and a non-eligible loss, so then in that particular case, my total income here will be the PGBP, which is 90 lakh, minus 20, which is 70 lakh. So 70 lakh will be my total income. I will get the deduction under ATIA as 90 lakh. I will not get deduction under ATIA for only 70 lakh. I will get 90 lakh. But it will be restricted to my GTI, which is, let's say, my GTI is 70 plus 25 lakh. So 70 plus 25 lakh is my GTI, which is 95 lakh. So in this particular case, I will get the deduction of 90 lakh in entirety. Are we clear? Yes or no? So where you have an eligible business and a non-eligible business. So if there is a loss from eligible business, you can set it off against the non-eligible business. Are we clear? But then in that particular case, what will happen in the subsequent years? What will happen in the subsequent years? So let's say this an example. So let's say in 2021, I have loss. So my GTI became 0. I set it off against a non-eligible business. In 21-22, I have, let's say, the income of 20. But here, can I get the deduction of ATIA, ATIB? The answer is no. Because what it says is that you have to consider that while computing the deduction, the profits of the eligible business shall be computed as if the eligible business was the only source of income of the assessee. So what you have to do is you have to first set off that loss against the eligible business while computing the deduction. So we'll not give the deduction for 20. We'll not give the deduction for 60 until and unless this 120 is set off. So even though your 120 has already been set off as against the non-eligible business, but for computing the deduction, I will consider as if the eligible business is the only source. So only when that entire profit loss is set off against the profit, then only I will get the deduction. So once set off of loss is allowed against any other source, deduction under ATIA is not possible in the subsequent AY. So the loss of the eligible business has to be first deducted while computing the deduction and the ATIA in the subsequent years also. Are we clear? So when, let's say for example, you will earn any income in the next year, so from that you will set off that loss of the earlier year. You will set off the loss of the earlier year, and for the balance, this will be of course a notional loss. This will be a notional loss, so the notional loss will also be set it off. Are we clear? Yes. Then, in this particular case, any kind of subsidies which are there, duty drawbacks which are there, so whether that will also be eligible for deduction under ATI, ATIB. So Supreme Court in Meghalaya Steels Limited case has held that the power subsidies, freight subsidies, interest subsidies between the profit of eligible business and the reimbursement of the cost has a direct nexus. So subsidies are basically what? Subsidies are basically to reduce the cost. So there's a direct nexus between the profits of the eligible business and the reimbursement of the cost. So subsidies are granted to reimburse the cost incurred for manufacturing or selling the product. So therefore, these are revenues derived from eligible business and qualifies for deduction under ATI. Are we clear? How about the duty drawback? Whether you will get the deduction under ATI or duty drawback? So, duty drawbacks are incentives which are given under the custom law. So, these are not directly related to the cost of manufacturing like subsidies. So, under subsidies, what you have is, under subsidies, these are given to reduce the cost of production. Isn't it? So, the subsidies which are given to you are given basically to reduce the cost of production. That is a different thing. But as far as the duty drawback is concerned, the duty drawback which is there is not related to the cost of production. Isn't it? So the duty drawback which is given to me is not relating to the production. So in that particular case, duty drawback will not be eligible for exemption under ATIB. Are we clear? Any questions, any doubts so far? Yes or no? Fine. So any duty drawback is not allowed. Now moving on to the 10AA. Again in the 10AA, the eligible associate is the unit in SEZ which is engaged in the manufacturing or production or the provision of services plus export of goods or services. Now the export proceeds have to be realized within 6 months from the end of the previous year. The deduction here will be the profits derived from the export business. So profits of unit in SEZ will into export turnover divided by the total turnover. The consideration in foreign exchange which is realized within 6 months is only considered as the export turnover. Now both export turnover and total turnover should include the freight, insurance, telecommunication charges, charges for rendering the services outside India, and should exclude the freight, insurance and telecommunication charges, both the numerator and the denominator. The amount of deduction is for the first 5 years, it is 100%. For the next 5 years, it is 50%. And after 10 years, it is 50%, but subject to amount credited to the special account. Here also, the return filing and the audit is mandatory. Yes? Any questions, any doubts so far? Yes or no? Yes. If you have any questions, you can ask me. Yes. Shall we solve one question on the chapter 6A deductions? Yes. Shall we solve one question on 10AA, ATIA, ATIB, all of that? If there are no further questions. Okay. So let's solve one question around this particular point. Let me give you the question. One second. Give me a moment. Okay. Yes. Java Limited is engaged in the development of software and providing IT. Yes, it has two units set up in SEZ, Unit P and Unit Q. The export turnover set up in ET. This is the third year of operation. The export turnover, domestic turnover, duty drawback, profit on sale of import entitlements, salary paid, other expense, net profit, and foreign exchange gain is given. And there is other information is also given. So let's start with it. So how will we start in this case? Yes. How will you start solving? Quickly go through the question and let me know how will we start. Yes. Okay. So let's start first with the net profit. So what are my profits which are there, which are given over here? So profits are 502 and 753. Fine. So this is my net profit. What is the total coming to? One, two, five, five. Okay. Then what would be the next step? So then first we'll refer to the other information which is given and let's see what it's trying to say. So it says that for unit P, expenditure of rupees 24 lakh is in relation to the PFI paid on or the provident fund paid on 30th 11 2024. It should be and not 23. It should be 20. Okay. So what will happen in that case? So expenditure of rupees 24 lakh, which is paid toward the provident fund, is paid on 30th November 2024. So yes, we will disallow the expenditure. Sorry, this is interest, not the provident fund. This is interest paid to the public financial institution. Sorry. So this is interest paid to the public financial institution after the due date. So therefore disallow the expenditure of interest paid to the public financial institution. Under which section I will disallow? Under section 43B. As paid after the due date under section 139(1). Fine. So what is the amount? 24 lakhs. Next is export sale of rupees 120 lakh, or sorry, export sale proceeds received in India are 1040 lakh. So that we will at the moment reserve it. We will not use this information at this moment. Next, what is given is export sale of 120 lakh includes freight and insurance of 200 lakh. Let's keep this aside as well. 1200 lakhs. And realization of 1040 lakhs includes insurance and freight of 140 lakhs. Okay, let's keep this aside as well. Export sale includes the expenses incurred in foreign exchange of 100 lakhs. Then for unit Q, it says export sales received in India is 850 lakh, and then the cash expenses are 47 lakh. So for now, we will consider, we will disallow the cash expenditure. So expenditure paid in cash disallowed under which section? 43. This is 47 lakhs. Fine, this is 47 lakhs. Now what we will do? What will be my total income? 1326 lakh, isn't it? My total income will be 1326 lakh. Now, how will I calculate the deduction under section 10AA? What will be my deduction under section 10AA? So the deduction under 10AA, which is going to be there, now you will have to compute that. What did I say? What is my deduction under 10AA? So first we'll start with the net profit again of the SEZ unit. So net profit of SEZ unit fee 50 lakh. Now will I allow this deduction on 502 lakh or on the disallowed amount also? So as I told you that on the expenditure which is disallowed, the CBDT circular says that you have to allow the deduction on the enhanced income and not just on the income before the disallowances. So here we will consider the disallowed expenditure of rupees 20. Isn't it? So my enhanced income is what I will consider. $526 then. Isn't it? Now, what will be my deduction over here? Deduction under 10AA is on the profit derived by the eligible undertaking. Profit derived by the eligible undertaking. So let's read this now information which is given. So it says export sale proceed in India, received in India are 1040 lakh. The exports, okay, sorry, before this information, there's also information over here. There is export turnover, there is domestic turnover, and there is duty drawback. In the net profit, we have the duty drawback also included. So whether we will apply the deduction under 10AA on duty drawback, the answer is no. So we will reduce here duty drawback. This is the Orchid Pharma decision. Isn't it? I just now told you as per the Orchid Pharma decision of Supreme Court, the duty drawback is not considered as the profit derived from derived from eligible business. This is not the profit derived from the eligible business. So I will reduce this 38. Are we clear? Then profit on sale of import entitlement. Profit on sale of import entitlement. Whether this will be eligible for deduction. So answer is no. So again, this is not profit derived from eligible business. So we will also reduce from profit derived from import entitlement. So yes, so this is again 24 lakhs. Okay, this is again 24 lakhs. So how much it is coming to? Is there anything else? No. So 526 minus 38 minus 24. This comes to 464 lakhs. Yes, so this is my profit derived from the eligible business, right? So you can just write it over here. So for the purposes of the total income calculation, we will not exclude this, but only for the purpose of 10AA deduction. Are we clear? Now, what will be my 10AA deduction, students? Yes, what will be my exemption or deduction under 10AA? Profit derived. So, deduction under 10AA is profit derived from eligible business into export turnover upon the total turnover, right? So in that particular case, what will be my export turnover in this case? Yes. Sorry, what will be my profit derived? It is 464 lakhs, isn't it? Into what is my export turnover? What is my export turnover? 1200 lakh. Now here there is other information is given. Expenditure of 24 lakh, this we have already considered. Export sale proceeds received in India are only 104 lakh. Right? So only 1040 I will consider. I told you that this should be the proceeds which are realized in India within the period of 6 months. Then it is saying export sale of 1200 lakhs. Export sale of 1200 lakhs includes the threatened insurance of 200 lakhs. So will I consider the threatened insurance over here? The answer is no. I will exclude that as well. I will exclude that as well, the 200 lakhs. And realization of 1040 includes the threatened insurance of 140 lakhs. So I will exclude 140 lakhs from the numerator and 200 lakhs from the denominator. Export sale includes the expenses incurred in foreign exchange of 100 lakhs. So that also I will exclude. So that will give me my turnover over here. So I will first of all only consider 1040 minus the freight and insurance of 140 lakh minus foreign exchange expenditure which is given is 100 lakh. Right? And from the denominator, I will consider the total turnover. My total turnover will be what? Export plus domestic. Yes. My total turnover will be what? Export plus domestic turnover, which is 1400. Minus, here I will not exclude 140 because here we will exclude 200. That's minus 100. So this will give me my deduction under, so 1040 minus 140 minus 100, 800. And denominator comes to 1100. So 464 into 800 divided by 1100. My deduction comes to 337. Yes or no? Are you getting this answer? Yes. Are you getting this particular answer? Yes or no? Fine. So 337 lakh. Okay. Now this is my deduction under 10AA. So I will reduce it. And this will give me my net profit as the amount minus deduction. Are we clear? Yes or no, students? Any questions? Any doubts so far? Yes. Let me know if you have any questions. You can go through this question for 1 minute and let me know if you have any questions around this. Yes. Fine, students. Yes or no? Fine. So this is about the chapter 6A deduction. Are we clear? So we have revised that one as well. We'll quickly recap now the other provisions which are left out, and in the next class what we'll do is we will start solving the question, one question around the transfer pricing, and other than that we will spend time on the judicial updates which are there. Fine. So whatever rest of the provisions are remaining now, we will just quickly recap for you so that you have the idea around those provisions. Okay. So now what I will be doing is I will also be revising some part of the set off and carry forward of losses, especially section 79, which is there. And other than that, of course, both the rest of the provisions are very, very simple. Fine. So section 79, which is there, we'll just quickly run through that. So 79 is carry forward and set off of losses in case of change in the shareholding of a closely held company. What is closely held company? Which is a private company or unlisted company. So in case a company is other than the startup, then carry forward and set off of losses shall be allowed if shareholders carry not less than 5% or 51% of the voting power remains the same in the previous year in which loss is incurred and the previous year in which the loss is set off. So the shareholders not less than 51% should remain the same in the year of set off of loss and in the year of the when the loss was incurred. So let's say, for example, if you see A, B, C, D are equal shareholders and the profit and losses are like this. So during the previous year, 23-24, A sold the shares to Y. And during the previous year, 24-25, B sold shares to Z. So the profits of 24-25 is 45 lakh before charging the depreciation. The profits of 23-24 is 18 lakh before the depreciation. Now therefore, in the year 21-22, There was only unabsorbed depreciation, so it will not impact that. In the year 22-23, there is a business loss. So the shareholders were A, B, C, D. In the year 23-24, when there is a profit, B, C, D are remaining same, and then there is Y. There is no problem. But in year 24-25, only C and D are remaining same, which are holding less than 50%. It should be more than 51% remaining same. So then in that case, in section 79 will get triggered and you will not be able to set off your losses in that particular year. Are we clear about that? Whereas in the case of the startup, what it says is that the loss incurred during the first 10 years of the incorporation, 51% condition will not be applicable. It says all the shareholders should remain the same in the year of incurrence of loss and in the year of settlement. So even if, let's say for example, in the year 22-23, A, B, C, D are equal shareholder, but in 23-24, A, B, C, D should remain there, but A can transfer rest of its shareholding to X and it should remain as 1% share. In 24-25, what it says is that, let's say for example, A, B, C, D, B, C, D also leave their shareholding and give it to Y and Z. That is fine. But they should remain at least 1% shareholder. So all the shareholders should be there in the year of incurrence of loss and the year of set-off. After the 10 years of incorporation, the same principle of 51% will be applicable. Yes or no? Is this clear? Section 79. Fine. So this is about the set off and carry forward of losses. I'm not going into any other provision under that. The rest you can look at the classes that we have already done so far. Then I will do just one penalty over here, which is 271. 270A. We'll discuss quickly over that. So penalty on the underreporting or misreporting of income under 270A. If my return of income is filed, if income assessed under 143.3, 144 or 147 for the first time is greater than income determined under 143.1, then in that particular case, I will have the penalty for the underreported income. Now, calculation of underreported income will be assessed income minus income determined under 143.1. And the tax on the underreported income will be considered here, and then accordingly the penalty will be calculated. Similarly, where ROI is not filed or it is furnished for first time in response to notice under 140, then income assessed minus the basic exemption limit. In case of the company or the firm, it will be assessed income. In case of others, it will be assessed income minus the basic exemption limit. And the tax on the underreported income plus the basic exemption limit will be considered as the tax. Are we clear? Then, in case of reassessment, income reassessed minus income assessed under original assessment. So if that is greater than that, there will be the underreporting of income. So income assessed minus income assessed under original assessment. Then in that particular case, I will have the tax on that underreported income. Then return of income has been filed on and the assessment is based on the basis of the MAT or AMT provision. Then it will be deemed total income assessed or reassessed. And if that is greater than deemed total income determined in ROI processed under 143.1, then in that particular case, there will be underreporting. What will be underreporting? Will be A minus B plus C minus D. A minus B is underreported income as per the normal provision. C minus D is underreported income as per the MAT or the ENC. Fine. Then reassessment results in the reduction of the loss or converting to income. Then there will be underreporting of income again considered, and in that case the tax will be on the the underreported income will be loss claimed minus income or loss assessed or reassessed. and then the tax will be calculated as if the loss was the total income. Fine. So this would result in the underreporting of income. Now, in case of the underreporting of income, there is 50% of the tax on the underreported income. In case of misreporting, it is 200% of the tax payable. Fine. Now, misreporting will be in the case where there is misrepresentation or suppression of facts. There is failure to record the investment in the books of account. The claim of the expenditure is not substantiated by evidence. Recording of false entry in books of accounts. Failure to record any receipts in the books of account having bearing on total income, or failure to report any international transactions or the deemed international transaction. In that case, it will be considered as the misreporting of income. Are we clear? Yes or no, students? Any doubt? So, shall we solve one question on this? Yes. So, I'm taking up this question only and let's solve this particular question. Let's solve this question. Okay. ABC is a domestic company liable to tax at the rate of 25%. Following are the particulars furnished by the company for AY 24-25. As per the return of income furnished under 139(1), it is 15 lakh loss. Determined under 143(1)(a), it is 8 lakh loss. Assessed under 143(3), it is 5 lakh loss. And reassessed under 147, 4 lakh is the income. So is penalty leviable under 270(a). These kind of questions are generally asked. So how will you start with it? Yes. Yes, let me know how will you start. Yes, students, faster please. Yes, I want your answers. Okay, let's start solving. So first is income determined under 139(1). Will we take that into consideration? Yes or no? Will we take that into consideration, the return determined under 139(1)? The answer is no. We will start with the income determined under 143(1)(a). Isn't it? We will start with that. So, we will start with income determined right. This is loss of 8 lakh. Now, this is the income assessed under section 143(3) is greater than the income determined under 143(1)(a) because this is 5 lakh. The loss is getting reduced, isn't it? So there's a reduction of loss. So then this will be considered as the underreporting of the income. This is considered as the underreporting of income. So there is a reduction of loss which is taking place. From this to this, there is a reduction of the loss. Now, how will you calculate the underreported income? The underreported income in this particular case will be the underreported income in this particular case will be 5 lakh minus 8 lakh. So negative 5 lakh minus negative 8 lakh. So because what the provision tells you is that the loss claimed under 143(1) minus the income assessed or loss reassessed. So basically here what we will do is, so under reported income shall be minus 8 lakh minus 5 lakh. So which will be minus minus will become plus, basic mathematics. So 8 plus 5 is negative 3 lakh. But the tax on this shall be calculated as if the loss is deemed to be the total. So on this 25% plus cess of 4%. This will be my tax on the underreported income. This will be my tax on the underreported income. Fine. So this will come to how much? So this is going to be 3 lakh into 25%, 75,000 plus 4%, 78,000. So 78,000 into 50% is my penalty on underreporting of income. So this is going to be 39,000. This is my penalty. Now this 5 lakh is again getting converted to income. So there is underreporting. Alright. Now what will be my underreporting? Minus 5 lakh minus 4 lakh. Right. So this will be my underreporting. Isn't it? So in this particular case also there is the underreporting of income because my loss is getting converted to the income. Sorry, 4 lakh, not I've done reverse way. So 4 lakh minus 5 lakh. This is also should be 5 lakh minus 8 lakh. Right? So this is going to be 9 lakh into 25% plus 4%. So how much it will be? Into 25% plus 25 plus 4% plus 34. Out of this, the penalty will be 50%. This will be, so my penalty 1,70,000. Yes or no? Any questions, any doubts so far, students? Yes? Fine. Okay. So this is about the penalty question as well. So with this, we have completed most of the provisions. We have revised along with the questions itself. Isn't it? We have revised along with the questions itself all the provisions which are applicable. Yes or no? Fine. Okay. Now we'll move to the transfer pricing class and the international tax class, basically to revise that. So that is also something then we will be able to solve in the next class. So for the transfer pricing, what are the conditions which are there? Applicability of transfer pricing, it is on any income, allowance for expense, interest, or any cost sharing arrangement arising from any international transaction. This shall be computed having regard to the transfer pricing. Now, transfer pricing provision will not apply if it results in decrease in total income or increase in the losses. So first you have to also check whether there are associated enterprise. If the answer is yes, then check whether there is international or deemed international transaction or specified domestic transaction. If yes, then check whether the transactions are at arm's length price. Now, associated enterprise is defined under 92(2)(a). So we have the general definition: an enterprise which participates directly or indirectly in the management control capital, that is the associated enterprise. Or if one or more person participates in the management capital or control of the two enterprises. Then there are deemed AEs, which are capital based. So, for example, if one enterprise holds more than 26% of voting power in another, or if a common person holds more than 26%, or there is interest in a firm AOP BOI where the enterprise is holding more than 10% in the firm AOP or BOI, or there is a substantial lender if one enterprise lends the loan to another for which is greater than equal to 51% of the total book value of the total assets of the borrower, or the one enterprise is guaranteeing greater than equal to 10% of the total borrowings of other enterprise, or if there is dependency on intangibles for the manufacturing or processing of goods, or there is dependency on the raw material which one enterprise is manufacturing or processing and greater than equal to 90% of the raw materials are supplied by another enterprise, or there is dependency on sale, or there is a common control by one individual or his relative, or by the HUF or the members of the HUF, or there is appointment in the board. So majority of the board or one or more executive directors are appointed either by one person or by one enterprise or by one particular person in two enterprise. So all of this would be categorized as the associated enterprise. Are we clear? Now, once we have the associated enterprise, then in that particular case, we will have the computation of the arm's length principle. So if there's associated enterprise, there is international transaction, there's SDT. What is SDT? SDT, specified domestic transaction, is inter-unit transfer of goods by an eligible undertaking to a non-eligible undertaking. Transaction between the entities having the close connection, which are claiming the deduction under ATIE, ATIB, 10AA, or the transaction between a company which is opting for 115 BAB and the person with which it has a close connection. Or now we have even the cooperative societies and the 115 BAE. So this will also include 115 BAE. Okay. And the aggregate value of the transaction is more than 20 crores. So then we have the calculation of the ALP. ALP will be, there are direct methods. Either the cup method is there, where you directly compare the price either with the internal cup or with the external cup. Internal cup is basically any internal transaction which has been undertaken, and external cup is the external transaction. So you basically make the adjustments for the volume discounts, for the warranties. So all those adjustments to arrive at a comparable price, you have to make those adjustments. For the insurance, for the freight, if it is at CIF or whether it is at FOB, the comparable price, you have to make the adjustment to arrive at a similar pricing so that there are no material differences in the transaction which will impact the pricing of goods. Then you have the resale price method. Under the resale price method, what you do is you compare the gross profit on sales with that of the comparable company. Then you have the cost plus method where you compare the gross profit on the cost to arrive at the AL. Then you have the transaction net margin method where you compare the net profit on the cost or the sales or on the operating expense or on the operating assets. So under TNMM, we adopt the different ratios to arrive at AL. Resale price method is applicable to the distributors. Cost plus method is applicable to the service providers. And then you have the transactional net margin method, which is the residuary method. And then you have the profit split method, where you allocate the profit between the two entities based on the functions they are performing, the asset they use, and the risk that they own. There is also the range concept, which is there. So in case the method is CUP, RPM, CPM, TNMM, and if the comparable companies are greater than 6, then you follow the range concept. If the comparable companies are less than 6, then you adopt the arithmetic mean of the ALP. Because if you have multiple ALP, you will arrive at the arithmetic mean. but the variation of 3% of the transaction price is allowed between the arm's length price and the transaction price. How is the range concept driven? Under the range concept, you calculate first the weighted average margin for the 3 years data, arrange the margins in the ascending order, obtain the 35th percentile and the 65th percentile. So percentile is basically total number of comparables into 35%. So whatever number you will get, the price on that range. 65th percentile is basically total number of comparables into 65%. So whatever number comes, the price on that range. This will be your arm's length range. In case the answer comes in decimal of the 35th or 65th percentile, then you round off to the next higher value. If the answer is whole number, then you take the average of the percentile and the next higher value. Take the average of that. So this will be your arm's length range. If the transfer price is between that arm's length range, that's fine. You find out then the median. So total number of comparables into 50% is your median. If it is not, then you have to make that adjustment to, and for making that adjustment, then you have to find out the median. Median is basically 58th percentile. So total number of comparables into 50%. Yes, are we clear or not about this? Okay. So in the next class, what we will be doing is we'll be solving a question on this particular point. Also, then we have the secondary adjustment. Secondary adjustment is if that the Indian company is pricing to a non-resident A and the transaction is not at arm's length price. And if the primary adjustment has been done, which is more than rupees 1 crore and which is not remitted to India within 90 days from the due date of filing return of income, then the secondary adjustment has to be made, which means the adjustment in the books of accounts of the assessee is to be made to reflect the actual pricing as per the ALP. So then in that case, the secondary adjustment has to be made. Now, secondary adjustment is basically a notional interest. If the transaction is denominated in INR, then 1 year marginal cost of one lending rate as on the 1st April plus 325 basis point is taken. If the transaction is in forex, then 6-month LIBOR as on 30th September plus 300 basis point is taken. If the excess money is not repatriated within 90 days, then there is an option to pay additional tax at the rate of 20.9664% on the excess money, and then the secondary adjustment will not. So you have an option to do that as well. Fine. So we'll solve one question around this. And the last one is limitation of interest deduction under section 94B. So what it says is that where the borrower is the Indian company or a PE of a foreign company who is not engaged in the banking or insurance business, borrows the money from a non-resident lender and pays the interest over 1 CR and claims the deduction. Or it does not borrow from a non-resident lender who is AE, but the AE has guaranteed that loan. So then the excess interest will be disallowed and can be carried forward for a period of 8 years. Now, what is my excess interest? Excess interest is total interest on debt less 30% of the EBITDA. Are we clear? So that is the excess interest which is disallowed to me. So let's say, for example, if a resident Indian company has borrowed 100 CR from ACO at the rate of 9%, loan is guaranteed by BINC, a US company. Now, KINC holds the share of both X Limited and BINC. So KINC has also deposited 100 crores with AINC. So in this case, these are related party as one non-resident is controlling both X Limited and the BINC. Are we clear? So there's a common control. So in that particular case, there will be the limitation. These will be the associated enterprise. Now net profit is 10 crores, which is given after debiting the interest, depreciation, and income tax of 3.4 crore. So we will calculate EBITDA. We'll calculate 3 crore. Plus, we'll add back the interest, which is there, which is 9 crore basically on 100 lakhs, plus the depreciation, which is there of 5 crore, and the income tax expenditure is of 3.54 crore. So that will be your EBITDA. 30% of my EBITDA is 8.22 crore. So interest that will be technically disallowed, the excess interest will be either 9 minus 8.22 crore or the entire 9 crore, whichever is low. So the lower amount is 0.78 crore. Now this 0.78 crore I will be disallowed. I will be disallowed. So total interest minus 30% of EBITDA, this amount will be disallowed and will be allowed to be carried forward over the period of 8 years. Are we clear? Any questions so far? Yes or no? Any questions? Any doubt? Yes? Yes, students, please tell me if you have any questions. I'll be happy to take. Yes or no? So in the next class, what we are going to do is we are going to solve the question on the transfer pricing and on the secondary adjustment. So we will do a question around that area. And once we solve the question, you will have an idea as to how the transfer pricing provisions are to be done. Are we clear? Fine. So if there is no doubt, I think we can just stop the lecture. But in case you have any questions, we can do that. Yes. Yes or no? Any questions? Any doubt? Okay, before we stop, I think what we can also discuss is the double tax relief obligation, foreign tax credit. How do you calculate the foreign tax credit? So, foreign tax credit is something that you will calculate based on the average rate of tax. So, you will calculate the rebate under section 90, relief under section 90 as per the DTAA if there is a DTAA. Present between two countries. If there is no DTAA present between two countries, you will give the rebate. Now, rebate is allowed. Basically, what you do, you calculate the total income, considering the foreign income also as per compute as per the income tax laws of India, and then you will calculate the tax liability. Now, whatever tax liability will come, you will divide that tax by the total income. That will give you the average rate of tax. So, average rate of tax in India or the rate of tax in the other country, whichever is lower, will be allowed as the deduction to you. Will be allowed as the deduction to you. So that is how you calculate the foreign tax credit. If time permits, we'll solve a question around that also. But if not, then you can of course revise it from the earlier classes. So with this, I think we'll stop here for today and we'll meet in the next class on Tuesday. Thank you so much. Yes.